Hello, and welcome everyone to this OMFIF Lee Kuan Yew School Roundtable session on one of the largest, slow-burning global challenges of our time, debt sustainability. Now, when we say debt sustainability, for most of us, for most of the general public, these are just two words, of course, and easy to say. But what they really mean is better expanded to, can we keep borrowing? Can we keep piling up what we owe in debt? And the attention that we pay to debt sustainability comes from contemplating what happens when we can no longer keep accumulating debt. Now, in the global economy, when the landscape contains a feature of imbalance that is unsustainable, but keeps growing nonetheless, then that feature, in many situations, becomes like a ticking time bomb. And the reset, when it finally comes, can be violent and harmful. It can wreak damage to the system, inflict financial costs and risks to ordinary people, to the taxpayer, that can have a magnitude that is multiplied many times over just the size of the imbalance itself. So this debt sustainability problem is exactly such a ticking time bomb challenge. It is historically long-standing. In normal times, in the public's awareness, the problem comes, the problem goes. But of course, today, in many parts of the world, the debt sustainability problem has obviously dramatically exacerbated due to the global pandemic lockdown. With me for this session, I've got a wonderful set of formal participants that you can see up on the Zoom stage with me. I will not take up our time rehearsing their many achievements and positions. Those latter are already put down in the webpage that describes today's roundtable. These participants will, in a minute, be considering the problem of debt sustainability against the specific theme, how do we reboot development finance? Now, the running order today is as follows. In a minute, I'm going to turn to opening remarks from two seasoned professionals in the field, Leslie Maasdorp and Ludger Schuknecht. They have each recently produced detailed, scrupulously researched publications on the matter. To facilitate the conversation, however, I've asked them not to make detailed presentations on their recent research, but instead to give just a 10-minute opening statement each on how they see the problem. After Leslie and Ludger, I will turn to the respondents, Meghna Desai, Denai Kyriakopoulos, and Urjit Patel, to each give an 8-minute response that allows them to present their own views on the matter, but also invite them to pick up on specific points in what Leslie and Ludger have said. Now, this session is on the record. There is a recording running right now, and that recording will be made available after the session. But after these presentations from my panelists and respondents, there will be a Q&A session with you, the audience. I want to invite all the participants in this discussion, those who have come in from Zoom or whatever, from everywhere else, to, as the session progresses, submit their questions on the Slido screen. Don't wait until the end of the panelists' contributions to start writing in. Feel free to pose your questions as we go along, and I will do my best to ask your questions for you in one form or another at the appropriate time. When you craft your questions, feel free to direct them at a specific panelist or seek to get the entire roundtable to reflect on a particular concern of yours. Those latter questions will be the ones that drive the conversation in this session. If I may, let me turn now to Leslie to start the discussion. Over to you, Leslie.
Thank you very much, Danny, for that kind introduction, and I look forward to this interaction today. Let me start off by saying that it's probably more appropriate to refer to this theme as rebooting multilateral development banks, because development finance constitutes a much broader array of institutions, including national development banks, bilateral aid agencies, the likes of DFID, USAID, KfW, and so on. My remarks are really confined to this class of institutions that we know as MDBs, referring to the World Bank, New Development Bank, Asia Infrastructure Investment Bank, Asia Development Bank, and so on. Second point I'd like to make is that there's an urgency to this conversation, Danny. As you correctly pointed out, there's a critical need right now to reflect on the role of these institutions in aiding and assisting the world through this post-COVID economic recovery. The COVID period in 2020 specifically reminded us how critical multilateral institutions are. As you know, the recovery and in fact dealing with the pandemic, as the initiatives have mainly been led by, whether it's the G20, whether it's the World Bank, IMF, and other multilateral institutions, they play a very unique role in global crises of this kind. In fact, they are custodians of the global public good. So dealing with crises like global pandemics, climate change, and so on, these institutions are best suited to confront those type of challenges. The third point to make is that these institutions responded in the main with speed, I would say, impressive speed after the outbreak of the global pandemic. But I would say that in terms of scale and the volumes of lending, they very much did not come to the party in filling the significant funding gap resulting from the COVID economic crisis. The next point I'd like to make is that these ideas are not just my own, they were developed and they are considered reflections, I should say, from the process of creating a new development bank, multilateral bank called the New Development Bank here in China. So we have been talking around these ideas since 2015. And in fact, one of the principal architects of some of these ideas, Mr. K.D. Kamath, who was the president of the bank in 2015, raised some of these issues way back in 2015. For example, the notion of whether a AAA rating is the ideal anchor as part of the design target rating for multilateral institutions. And I'll come to that in a little bit more detail in a second. If we could now turn to the presentation and to the first slide. The next slide. What I will do is really just three things. One, talk about what are some of the current trends that impact on the multilateral development banking world. Secondly, just dissect what in fact is this multilateral development banking world, just sort of dissect the business model, if you like, and then focus on what are some of the proposed changes to the model that I'm putting forward in this paper. And then finally, I'll just summarize it. Next slide, please. The first point to make is that the balance sheets of sovereigns, as Danny referred to earlier on, are significantly stretched today, specifically also because of 2020 and the economic dislocation that resulted from COVID. The shareholders of multilateral banks, therefore, are very much constrained in terms of their ability to inject fresh capital into the multilateral banking system. We all know another major trend is that COVID, we are still very much living through the pandemic right now, and it is still ravaging our economies throughout the developing as well as the advanced world. A third major theme today is the availability of significant surplus liquidity. And as you know, we are at near zero interest rates, which provides an historic and very unique opportunity to lock in, or rather for MDBs to raise more fresh capital at these much lower interest rates. The fourth major theme is this transition towards net zero and the low carbon future that needs to be crafted. And it's very clear that 2021 will mark a decisive change. It will be an historic turning point, I would argue, which will likely be captured in COP26 when that takes place. And its significance will only be paralleled, I think, by the Paris Agreement. But what this means for MDBs is what I want to dissect later. Fifthly, I would like to argue that there's a very sovereign-centric, nation-centric sort of lending model which underpins the multilateral development banks, and that ought to be re-looked at, and there's some changes proposed here specifically because of the importance of local development actors, specifically national development banks, but also cities and municipalities who are much closer to dealing with the specific challenges to meet the Sustainable Development Goals. And then finally, I would argue another major trend underway is the significant changes and disruptions happening driven by technology. And we need to tap into the possibilities and the potential that new technology offers in redirecting the mandates of multilateral development banks. Next slide, please. So when you look at the current multilateral banks, now I'll do this very briefly for those maybe who might not be so familiar with multilateral banks. The first point to make is that multilateral banks are sort of cooperatives, if you like. So we really pool sovereign risk. So let's take, a bank like the World Bank, which many people will be familiar with. We have 188 member countries. You have countries that are, don't have credit ratings. You have countries that are sub-investment grade, and you have highly rated countries that are AA, AAA, and so on. But the way that the model is structured is such that the risk is pooled, and the bank does not differentiate in terms of the different credit qualities of various members, and they provide sovereign loan pricing, for example, which is uniform. The second key aspect of multilateral bank business model is that they have extremely low leverage. We hold high levels of liquidity. In other words, even in moments of distress, like 2008, for example, these banks hold sufficient liquidity to meet all of their obligations into at least for the 18 months into the future. So they can continue to make disbursements on projects, they can continue to pay to service their obligations to bond holders, and they therefore able to withstand significant stress events in the credit markets. And as a result of these very risk-averse, very conservative balance sheets, they have extremely high credit ratings, either AA+ or AAA. Third key feature is that these banks borrow cheaply based on that high credit worthiness, and then on lend to sovereigns. Fourth key point is that because there's no liquidity backstop, we do not have a IMF or a central bank, as a liquidity backstop, and therefore we have to go to shareholders when we need to get additional funding for to increase our lending capacity. The fourth key point is around the processing time. These institutions play a very critical role in developing world, but I should add that they have become very bureaucratic. There's a bit of inertia, slow approval processes, which makes it quite cumbersome. And to process a single loan can take up to 12 months. Finally, as I mentioned, there's a sovereign nation-centric sort of element which underpins the model. And then most importantly, they're counter-cyclical in design, meaning they best play their role during moments of crisis. Next slide, please. This is just very briefly to show you the scale of the MDB system. The total volume of loans outstanding is around 1.5 trillion. The total equity capital, which includes accumulated reserves of the institutions, combined institutions, is around $620 billion. The total asset base around $2 trillion. And to just give you a sense, if you take the combined response package for COVID-19, it comes to about $300 billion. It's really a small amount in the context of the more than $16 trillion of fiscal stimulus that has come about as a result of the COVID crisis. Again, just to give you a sense of order of magnitude, the total MDB balance sheet only comprises 2.5% of world GDP. And to compare it for those central bankers on the line, it's roughly, the central bank balance sheets, the top four, the Fed, PBOC, Bank of Japan, ECB, comes to about 30 trillion. That gives you an order of magnitude. Next slide, please. So how should the MDB business model be reconfigured? I'll just very briefly make a few points here. One, in terms of scale, we need to focus on how can we enhance development impact, and where's the scope for further agility and speed of execution, which is something, again, which we at the New Development Bank placed a great deal of emphasis on when we created the institution. Secondly, we need to be more responsive to borrower needs. Thirdly, there's a culture of lending which dominates these institutions and needs to move away more towards risk mitigation. We need to use more these very highly creditworthy balance sheets which we have in order to improve the risk return profile of projects and environments in order to mobilize more private sector capital. Fourthly, and this is a very important point, that institutions like the MDBs, they very much focus on their own metrics, their own internal targets. It's much more important today to look at their role in a more systemic way in terms of how they impact on the broader financial ecosystem as a whole. I'll give you one example. The green bond market comes to mind. In 2006, the green bond market did not exist. 2007, the European Investment Bank issued the first green bond. 5 years after that, mostly multilateral banks issued IFC and many other MDBs. And post 2012, the market exploded. Today, it's more than $1.2 trillion. So instead of us looking at green products, green instruments ourselves, we should be shaping the entire financial industry and playing more of a frontier role in terms of new innovation. Finally, on the slide, I just wanted to say that these institutions still function as individual enterprises, and core standards actually diverse around ESG, for example, procurement policies, the nature of contracts, and even our approval processes, even loan pricing varies from institution to institution. So there's scope for conversions, which is what I argue for in this paper. Next slide, please. So there's really three sort of core areas that I'm proposing here. One, that there needs to be, we need to revisit the capital adequacy metrics and all the fundamental risk metrics that currently underpin the MDB model. Secondly, a number of aspects of the lending operations are too inflexible and needs to change. And then finally, some institutional changes where there's also scope for further innovation. The next slide, please. The next point I want to make, and this is really very core and central to the paper, and this is an idea which Mr. Kamath raised way back in 2015, is should AAA be the optimal credit rating that multilateral banks ought to strive for? And we came to very conclusive, or we arrived at the conclusion really that this imposes way too much restrictions on our ability to conduct our business, and therefore we believe that even going down one notch can significantly unleash additional capital headroom for further lending into the future. I specifically argue in this paper that the current sort of model, the way in which credit rating agencies set the metrics, the leverage ratio, the amount of capital that the banks need to hold is too restrictive. And it does not take into account the unique characteristics of multilateral banks. Some of these are the following. One, we have preferred credit treatment. We have this large volume of something which commercial banks don't have, called callable capital, which is completely underutilized. Thirdly, there's hardly any defaults. If you look at the actual default experience of MDBs. Fourthly, the rating agency methodologies do not take into account the counter-cyclical role which we play, nor do they take into account the strong sustainability objectives of our institutions. And I should add, though, that this idea, as heretic as it might have sounded when Mr. Kamath raised it the first time in 2015, today it's pretty much, there's a wide emerging consensus around this concept. The difference, for example, in the bond yields between a AA plus institution and a AAA institution is only 10 to 12 basis points. It is so negligible that the cost really of keeping a AAA outweighs the benefits, is the short point that we want to make here. Next slide, please. The key point that I'd like to emphasize is that After a 3-year hiatus, the Eminent Persons Group of the G20 in 2018 raised this idea for the first time in one of the chapters. And finally now, 2 weeks ago, the G20 presidency of Italy, they have just announced a week ago that they will be proposing a commission to review the capital adequacy metrics, an independent body to review the capital adequacy metrics of MDBs. So this idea is finally gaining traction. And just to give you a sense, I argue there that if you increase the leverage ratio from currently around 3 on average to 5, it can translate to an additional $1 trillion in additional funding available for lending. That is a considerable amount which can completely change the development trajectory. The final point to make there is that a question should also be asked whether there isn't a possibility of a lender of last resort to be put in place, whether it be the IMF or a combination of arrangements with the central banks. But the idea that there should be a lender of last resort is also something that we should give consideration to. Next slide, please. Yeah, I'll just be very brief in saying that MDBs raise capital in very traditional mode. We have, as I mentioned, paid in capital and equity and build up reserves over time because we do not pay dividends to shareholders. But for example, MDBs have not issued hybrid capital in the past. It's only very recently, a year and 2 years ago, that the rating agencies incorporated into their methodologies the idea of hybrid capital instruments. So we will now be able to we should be able to raise fresh capital, and or even the idea of issuing perpetual bonds would be something that will enable us to boost the capital metrics of the MDBs. Finally, under the capital metrics, we also have a originate and hold model, if you like, on our balance sheets. We do not recycle capital, which is typically what commercial banks do. So moving away from this originate and hold more towards originate and distribute will enable the MDBs to use their balance sheets in a more optimal fashion. Next slide, please. On callable capital, I'll just be very brief here. There's a very interesting report which Standard & Poor issued in 2016, suggesting that in fact it's the multilateral banks themselves which have been conservative, if you like, in not utilizing and leveraging of callable capital. Eligible callable capital at the moment within the system, 2019 numbers suggest there's $400 billion of capital, which is literally unleveraged because the rating agencies in the past have not really given explicit recognition for this class of capital. Next slide, please. I won't say much about mobilization. The key point, the reason why I won't say much about this capital mobilization from the private sector is that there's a high degree of consensus around this point. So there's nothing contentious about the notion that public funds need to be utilized more optimally in the areas where it's needed most, and that we need to channel more development finance, more private sector capital rather, into development finance. There are particular reasons why the private sector has been reluctant to invest, especially large institutional investors, but we believe that there are ways to de-risk the infrastructure investment environment to crowd in more private sector capital. Next slide, please. There are specific areas where there's opportunity also to be more effective in this mobilization domain. One of them is to look at the possibility of doing more credit enhancement, because we are the highest rated institutions in the financial world, but we do not effectively use that high credit worthiness to improve the risk profile of, for example, other emerging market bond issuers. And in that way, we can make the infrastructure, for example, more attractive to your large institutional investors. And there are various options that I outline in the paper of how that can be done. Next slide, please. Again, ESG, I won't say much. You all know that we are at an historic turning point right now. The world is, there's a broad recognition that we need to shift our paradigm completely away from traditional infrastructure towards ESG and developing new green instruments there's almost uniform agreement today. More than 60% of the world have already adopted 2050 as the date to reach carbon neutrality. And therefore, MDBs now have to go back to the drawing board to direct almost all of our lending towards the ESG space. Each MDB at the moment have 30%, 35, 40% targets. We should be looking, as I said early on, to market outcomes and shaping the entire financial sector, who needs to play a critical intermediary role to enable new business models and re-engineering of our lives as we know it towards sustainability, because everybody agrees that climate change is the most important challenge facing the planet today. So we can just go to the next slide very briefly. I would just make one point under ESG, that the space has developed so much today that, for example, here in China, where we are located, the New Development Bank has just issued the first SDG bond here, and there's a explosion of green financial instruments. And this is only going to continue as regulators capture this in their the design going forward. Next slide, please. Again, I won't say much about local currency financing. This is also a very uncontested notion. The model of MDBs have been too focused on US dollars. We currently here in China alone do about 45% of our infrastructure exposure in renminbi. There's obviously well-developed capital markets here, but so also in India, in South Africa, Brazil, and other BRICS countries. But we believe it is much more important now to develop local capital markets, and through investment in infrastructure projects to avoid the FX foreign exchange mismatch that results from countries borrowing in US dollars, and when their currencies depreciate, them having to pay back significantly more. Next slide, please.
Yeah. Thank you for such a wonderful vision of what the future of these MDBs will look like. Really, really exciting. I'm keen to, really wonderful. I'm keen to proceed now to Ludger and to the respondents, because you've given us so much material to think about already. If I may, can I turn? Thank you very much. Thank you. May I turn to Ludger now?
Thank you, Danny. And let me pick. Can you hear me?
Yes, hear you fine.
Yeah.
Excellent.
Great. I'd like to pick up where, in a way, you brought us in the beginning, and where Leslie started off with the question of fiscal sustainability. And I would argue that the need to reconsider how we finance in the development area, and how we deal with this high debt, this mountain of debt that we have now, is really something that we need to also understand better, because right now, not everybody believes that we have a problem. Some think, on the contrary, we should have more debt. So I think to spend a few minutes on where we stand, what the risk factors are, and what possible scenarios are, how this high debt could unfold, is I think perhaps a good complement to what Leslie has been saying. So my thesis is that, contrary to what we have seen in the past, where high debt and sustainability was typically an issue of smaller or medium-sized countries, we have now more of an issue at the global level, with many large countries facing record indebtedness. And that, of course, links up with what you said, Danny, that then the implications of this become difficult to predict. So if we go to the next slide, this is my favorite chart. It's an IMF chart from last year, where you can see how, in the past, we've always had ups and downs in debt. Before, in peace times, debt went down. In crisis times, war times, debt went up. The height was after World War II, and then we had a generation of debt reduction until the mid-70s. But since then, especially in advanced countries, there's only been one direction, that was up. And for advanced countries, the debt ratio is now back to the level of 1946. Emerging economies are also at record ratios, just about half of, or a bit more than half of what advanced countries have. And while advanced countries' direction has been basically up, emerging economies have shown more of a Keynesian pattern, up in downturns, down in upswings. So I think this is also something that is noteworthy in the situation today. And when you look at projections for debt ratios in Europe, in the US, there is really no perspective for a decrease. And there's also no sense of urgency for a decrease. So this is an environment where, to my mind, we should really be alert. But there are a number of other fiscally relevant risks that partly are well known and well considered, but some are less on the radar. What is well known is the challenges from population aging. And we know that on average, we'll have 3 or 4% of GDP of additional spending across emerging and advanced countries. And in some individual countries, this can be as much as 10% of GDP. And then we have an issue of future financial crisis, where we, if we take the past as any kind of lesson, should be ready that if any such crisis happen again, they'll have again a major impact on debt. And then the question is kind of from a risk management perspective, shouldn't we have again some buffers? But if you go to the next slide, there's two aspects I want to focus on, at least for a minute longer. And that is, the first one is public spending. Mostly this is kind of treated a bit nonchalantly. People say we should now focus more on investment, on health, getting government, in shape. That is a good observation, and better spending is certainly what we all need. But I do think that the size of government is not irrelevant when we look at our debt challenge. Because you see here, you have the size of government varying enormously in advanced countries and emerging economies. These are only advanced countries, but you can almost have a similar picture for emerging economies shifted a bit to the left, where France now has had the public spending in 2020 of well over 60% of GDP. And we have had countries with smaller public sectors more in the 30% range. This is, of course, COVID related. Some of this will go down again, as you see in the gray bars. The orange are the maxima. But there's a risk that these spending ratios will also stay higher than pre-COVID, after COVID. And that is not unproblematic, because when you look at spending ratios of 50, 55% of GDP, this is basically close to above what historically countries have been able to finance. And in some countries, the financing constraints are, of course, lower. So we risk that we'll not be able to really get out of the deficits that drive our debt ratios. And this is going to be harder for countries with big government sectors. These countries are also going to face the competitive pressure from new advanced countries, emerging countries, or those advanced countries that have much smaller public sectors. The taxes are simply going to be much higher, much more distortive. And then it links up with the question of the credibility of our fiscal frameworks, where confidence, all the IOs always say we need to regain confidence in medium-term frameworks, but at some point the medium term has to kick in. And after the global financial crisis, it never came. And well, now the risk is that it will not happen again. In addition, all of our, so to speak, relatively benign view of debt, it's not only a matter of low interest rates, the near zero interest rates, but also of growth prospects. And while our expectation, when you look at the medium to long-term forecasts, are not of more growth, but they're also not of less growth. And when you see some of the policy discussions we have now about more interventionism, more zombification, more protection, this is not necessarily to be taken for granted. Growth might go even lower, also because population aging shrinks our workforces. And we have additional financial risks in the system. Asset prices in many countries are very high. There's talk about booms that can turn into busts. There's talk about big monetary overhangs. There is talk about inflation pressures becoming more persistent than we currently see them. all these could be factors that then feed back into public finances and feed back into debt, and that are not so much on the radar now. And if I can show you my next slide, this is another risk factor that we do have on the radar, but perhaps not enough given the global scale of debt. And that is the growing interdependence and spillovers via capital flows. The dash for cash last March, I think, was, the kind of like the fastest sudden stop that we've ever experienced. We have the possibility of advanced country contagion, as we've seen in the global financial crisis. And so, what does this mean? It means, as Danny had said in his introductory remarks, it's difficult to see what then the spillovers and spillbacks would be if any of our larger countries got into fiscal difficulties. And I show you this table here on the right. We've basically had payment difficulties of countries in the 70s, where the UK took a loan of 2 or 3% of GDP. And you can see how this over time went up. In the 90s, we had IMF programs with 5% in Mexico plus some US involvement. And then in the global financial crisis, you needed programs of financial support in the order of 40% of GDP. So huge costs of fiscal crisis, not just nationally, but also potentially internationally. And now, if this is the situation today with high debt and fiscal risks, debt will have to come down at some point, and we do not really want to wait for that moment where it happens disorderly. There is scope for adjustment and reform, and when you look at the details, which I couldn't present here, the scope of adjustment needed is manageable. It's actually smaller than in many previous crisis episodes, like after the global financial crisis in Europe or in the 90s or 80s, but it needs to be done. So what are the 4 scenarios of debt reduction, if I can close with this? The first is the desirable one, to my mind, consolidation and reform, bringing debt down in an orderly manner. The second is debt restructuring. It will be something for smaller, advanced and emerging economies, perhaps in the future, but for large ones, if you think it through, more difficult. And we have financial repression, meaning, low interest rates with moderate inflation will gradually bring debt down. That's what we have now. But the question here is that stable? How long can we kind of continue in this scenario? And I think we can continue in it a long time, but it means that we need to maintain confidence. Otherwise, there's a risk scenario of destabilization and much worse outcomes. So I hope that in a way, 3, the financial repression buys us time so that we get to 1, consolidation and reform.
Thank you very much, Ludger. I'm getting an echo.
It's fine on this side.
Okay, but thank you very much. So, got wonderful opening statements from Leslie, told us about some really innovative, forward-thinking on the part of MDBs. We've got Ludger warning us about the current conjuncture where we are now in terms of debt GDP ratios and the likely trajectories going forward. So really lots of issues, lots of substantive issues to dive into. What I want to do now is to turn to my 3 respondents. I'm going to begin with Magnat Desai. Magnat, I see that you've adjusted your iPad because we were kind of losing you earlier. But if I could invite you to provide your response to these 2 opening statements, please. I can't quite hear you yet. Your mute signal is still showing. Okay, thanks.
Can you hear me now? Yeah, well,
yep,
thank you, Danny. And of course, thank you for the 2 excellent presentations. You would not be surprised to know that I don't agree with either of them. First of all, on Leslie's presentation, I agree with him that the orthodox banking model is not suitable. It has never been suitable in my view, but not suitable for the challenge of development. And the more the lenders can go to AA rather than AAA and use local lending and be more adventurous, as it were, would be necessary. You see, I think basically the banking standards and orthodox finance was invented for the rich, who are always very worried about inflation or what will happen in inflation. The poor have never been catered for by the banking model. And what the COVID crisis has told us is that it's about time we looked after all the people in public finance and not just, in 2008, after 20 years of saying, oh, don't print money. We printed money like there is no tomorrow. Why? Because the rich were suffering. The rich had to be looked after. So we looked after the rich, spend money like there is no tomorrow. Nobody complained at that time, right? My view is, and we increased inequality and we neglected poverty. So my request is, don't think about debt GDP ratios, don't think about AAA, AA, think about mortality, sickness, health. We underinvested in health, which is why even developed countries found themselves short of supplies when the pandemic took place. Now, look at this. Ludger presented a very nice standard model, but he should notice, and I think he has noticed, the secret is, why are interest rates so low? It is not financial repression. It's because we threw so much liquidity into the market in 2008 that yields are very, very low. Now, this is the time to take advantage of those low yields and go out there and spread more money around, especially for developing countries. I mean, if yields are low or negative and inflation is absolutely comatose, I know everybody's worried about 2% inflation. We have lived under 27%. I remember I was in the UK in 1974. So, I think inflation is low and interest rates are low. And the orthodox finance people have to explain, why is this the case? My view is this is an opportunity, go out there and lend money. I think the interesting thing that Leslie said was the default rate is very low. And this is always more or less conventionally true. There's a man called Amadeo Giannini, who in California, who during the San Francisco earthquake just stood out there and said, whoever wants money, I will lend them to you. Because no security, nothing. Why? Because he knew that most people are honest. Most people would give money back. I think the New Development Bank has to actually follow that procedure, lend out money to the emerging economies or even the non-emerging economies who need it more. Trust that they will not default, and try and do as flexible lending as possible and not worry about anything else. On Ludger's side, I would say, don't worry about the debt. Worry about the debt servicing ratio. How much is debt servicing charge a percentage of GDP? If that is safe, then you can borrow any amount. Why? Because interest rates are historically low, and I think they're likely to remain low. I think inflation, I've said, is likely to remain very, very low. Central bankers are desperate to raise inflation to 2%. I mean, I never thought I would live to see that kind of climate, having lived through 70s and 80s high inflation. So the world economy has changed fundamentally, and we haven't actually modeled why that is the case. We're still going on by the 1970s model. And I think one very interesting observation or thought I have is the money that the central banks throw into the financial markets stays in the financial market. It doesn't impact the real economy. There's almost like a quarantine between the goods market and the financial asset markets. So all the money that all the central banks support into the financial market has stayed in the financial market. It's desperately looking for other high yielding assets, and there aren't any. So we have happily a low yield ratio. And so my view is that this is a time when there's a demand for adventurous banking policy, and there should be a supply of adventurous central banking lending, borrowing, and I think we may at last convey the benefits of financial markets to those who really need it, i.e. the poorer people. Okay, I won't go any further because I think I know that other people want to talk. Thanks.
Thank you, Magnat, for your always provocative views and for your colorful, vivid imagery. I know if I were either Leslie or Ludger, I want to jump into the conversation, but I'm going to have to ask you to hold off for a bit because I want to now turn to Denai. Denai, from your position as Chief Economist, Managing Director of Sustainability Institute at OMFIF, what is your take on the views that these other economists have presented so far? Over to you, please.
Thank you, Danny, and thanks for the very interesting presentation so far. And I have to say, I agree with what Magnat said in terms of what you can measure, you can manage, and you can target. And I think we are really realizing that we have to change the way that we measure economic development, and the focus on growth is being replaced by focus on other indicators as well that better reflect sustainability. I think the example of debt is a very good one in terms of not just focusing on the absolute level of debt, but also on a more nuanced approach to assessing debt sustainability. And Ludger and I have discussed this in many other panels before as well, and I know he has a very nuanced view on that too. But I think thinking about the starting point, yes, we do need to rethink the system of development finance, but I think it's important to maintain a focus on an open order and competitive world order, because that has delivered results so far. It has lifted many people out of poverty. It has provided foundations for development. So I think it's important to bear that in mind. But having said that, conditions have changed and are changing. The system of international governance and cooperation that has underpinned the system that we have had so far is weakening in terms of international cooperation. That is something that needs to be addressed. And also the world, even though it's now more interconnected, it's also more local in terms of the challenges that we're facing. So that is the background. And then what do we need to do to, in the face of these conditions? I think the first thing to say there is that, yes, we're talking about development banks and development finance. National government policies are still at the heart for a lot of the issues that we're facing, and that is something that we should not lose sight of. And I think it's important to maintain a view that these should be complementary and not substitutes to the work that development finance and development banks are doing, and how we can leverage those synergies to create win-win outcomes. I think the second thing to say is that we don't really need new players. Both Leslie and Ludger mentioned some of the work that some of the development banks have done. I think it's more about how to leverage synergies, how to connect them, how to develop common standards across, and also how to use them to enhance the global financial safety net, which is something that OMFIF has written a lot about, because a lot of the shocks that hit regions, they may hit regions regionally. So in the case of the euro area crisis, for example, you had everyone want to tap the financial resources at the same time. So how do you strengthen the global financial safety net in a way that countries that have strong fundamentals can still access it and not be stigmatized by accessing this kind of finance? I think that's very important. And then finally, because I know we are running out of time as well, I wanted to talk a little bit about sustainability, which is something that both Leslie and Ludger mentioned in their remarks in terms of the environment and climate change, which of course with COVID, we have realized how much vulnerable the system is to outside factors outside the financial system. And Magnat mentioned it just now as well, that there is a disconnect or a quarantine between the real economy and financial markets. And I think we have managed to achieve the separation of the two for some time now in the COVID crisis, but of course you cannot have that sustainably going on for too long. Either the real economy will have to adjust to match the optimism that we have seen in financial markets, or the shielding, let's say, that central bankers and others have managed to achieve in terms of making sure that the crisis in the real economy does not become a financial one as well. But you cannot have the two disconnected for too long. And I think in the case of environmental sustainability, common standards are absolutely crucial in terms of making sure that private sector partners that work with development banks can expect the same and can lower the cost of working with different partners, different development banks. And with some metrics, this will be possible because a ton of CO2 is the same in the Middle East and the same in Africa and Latin America. But with some other indicators, I think we still need local standards and taxonomies. For example, a liter of water in a very dry area in the Middle East will not be the same as in a country that has a lot of water in the developing world. So I think this idea of how do we develop local and global taxonomies, where we have so many different fragmented initiatives at the moment, will be key in terms of really scaling up sustainable finance. And the second thing where I think development banks can really make a big difference is the scaling up of sustainable asset classes. So Ludger also mentioned the European Investment Bank was the first to issue a green bond and kicked off that market, which is growing very fast. It's still small. The Asian Development Bank was one of the first that issued a blue bond. The African Development Bank was the first to issue a Corona bond last year. So we are seeing really a lot of innovation coming from the development banks. What we need, I think, is not so much the innovation, is more the scale. And that's something that we're hearing from asset owners that we survey every year at OMFIF. And just last week, we published the latest edition of the Global Public Investor Report, which our team worked on, and you can download on the website, where a lot of these very big investors, pension funds, sovereign wealth funds, said we would love to invest in sustainable asset classes, but there is not enough scale and liquidity for us as big investors to make it worth it. So I think that's something where their development banks jointly can work very much on. And beyond the asset classes that I mentioned, there's been a lot of talk about developing infrastructure as an asset class as well. You cannot expect very big investors with hundreds of billions assets under management to go after small infrastructure projects in developing countries. You really need to have a scalable asset class. So I think that's very important too. I have also some comments about the local currency markets, but I'll leave these for the discussion in the interest of time. Thank you, Dani.
Thank you, Danae. Thank you very much for circling back to some of these larger sustainability issues, which also connect with some of the things Leslie was saying about reforming MDBs. Thank you very much for that reconnection. Mr. Urjit Patel, can I turn to you now? Last but not least, you're a former central banker, previously Governor, Reserve Bank of India. And some of the things that we're talking about now can either fit in what you might consider good practice, but some of the things that some of the participants have talked about veer into what you might think a little bit really pushing the boundaries. I'd like to get your view on how this conversation has gone, please. Over to you, please.
Thank you, Professor Kuan. I'll make three sets of points in my opening remarks, namely constraints on emerging markets in response to the COVID-induced macro challenges, the comparative outlook for the fiscal situation, and thirdly, a comment on the conceptual changes with regard to data aggregates that are being implemented, I think, for official use. So emerging markets made choices last year and this year regarding macroeconomic management, keeping in mind five things. One, the initial conditions with respect to availability of the policy space available. Secondly, they had to keep some ammunition dry due to uncertainty over the evolution of the pandemic and consequent implication of keeping economic sectors going. And they were vindicated with the second wave, etc. Third, energy importing emerging markets, which is a large class, did benefit from the collapse in oil price for about 12 months. And the choice governments have made is whether to pass on the benefit to consumers or tax away the difference and so help the fiscal situation. Fourth, an emerging market currency is not a reserve currency by definition. We know from experience that global flows are fickle, so policy risk aversion is understandable. And fifthly, if reputation for prudent macroeconomic management wanes, then flows will be affected vis-a-vis EMs. We know this most recently from the taper tantrum episode and others in the past. EMs have relied more on monetary policy as they entered the COVID phase with limited fiscal elbow room. On balance, the success of keeping inflation more or less under control coming into COVID allowed EM central banks to aggressively cut policy rates, and in several economies, real policy rates were negative. EM central banks, excluding China, expanded their balance sheets last year by about 5 percentage points of GDP. including support for official lending. If we look at the fiscal data, including projections from the IMF's fiscal monitor, for groups of countries from 2020 to 2025, two things are apparent. One, countries that can afford to do so have borrowed more, and those that didn't have the fiscal space coming into COVID have been cautious. For example, the G7 increased the fiscal deficit by 9 percentage points of GDP in 2020 from the previous year. In contrast, low-income countries increased by barely 1.5 percentage points of GDP, and emerging markets, middle-income countries, somewhere in between, by about 5 percentage points of GDP. The second point is that projections put out in the public domain indicate that by 2025, all of this will be reversed. So, for instance, for the G7, the general government fiscal deficit in 2025 will be 3.5% of GDP, which is slightly lower than the number in 2019. It is not unreasonable to take this with a pinch of salt. Time permitting, I can cite reasons for this later on. But let me move on. One conceptual change for calculating debt and assessing sustainability of fiscal programs is the modification that is gaining traction, specifically moving from looking at gross general government debt to net general government debt aggregates. While this change is qualitatively an improvement and useful, we need to be careful that the consolidation and netting out is done correctly in a manner that is complete so that it is progress and does not smack of heads I win, tails you lose, to record and highlight lower debt numbers. In brief, I'll go through an illustrative list that could be kept in mind in the interest of comprehensiveness, uniformity, consistency, and comparability, even as a few judgment calls have to be made in regard to calculating the net debt numbers. Firstly, the measure should be net public debt, that is debt of all levels of government, federal, provincial, state, and county and local authorities. The so-called hidden debt has to be included. So we need to move from general government to public debt if we are going to start using net debt numbers. Secondly, domestic and foreign currency debt of government-sponsored enterprises and public sector units should be included, as also debt on the books of special purpose vehicles set up for infrastructure and other projects by all three levels of government. The central bank balance sheet should be included in the exercise, in particular, the central bank's ownership of government debt. I think we should acknowledge and internalize that modern monetary theory is being practiced full throttle, and that the central bank should be now consolidated with the government statistics when it comes to aggregates. Also, foreign currency assets, special drawing rights issued by the IMF, and gold officially held by either the central bank or the government should be netted out. These two adjustments, keeping all other things equal, will lower net public debt numbers. A measure of contingent liabilities in the form of financial guarantees given by governments should also be looked at and included somewhere in this net debt number. Governments all over the world need to come clean on this with regard to definitions and skin in the game. Perhaps a quantitative evaluation of unfunded pension liabilities of the defined benefit kind promised and underwritten by the government need also be included. Lastly, in some countries, the government owns banks and other financial institutions that take deposits from the public. To what extent these can become sovereign responsibility in the event of stress is an important judgment call that may also need to be made as this transition is made to net debt numbers. There is a confluence of thinking amongst important stakeholders to seek comfort in portraying national debt numbers in a certain way. So technocrats and guardian institutions like OMFIF should perhaps make themselves heard to keep stakeholders honest, even as net public debt numbers form the basis of fiscal sustainability analysis in practice. I'll stop there. Thank you.
Thank you, Urjit. Thank you very much for that wonderful putting together of so many different ideas. I've got a huge list of questions here, so I'm not going to be able to say them each one by one, but I'm going to try and clump them. And the first clumping I'm going to direct initially to Leslie and Ludger, but then spilling over onto the respondents as well. And I think of this first clump of questions as having to do with what if the future is different? What if the future is different from how we see it now? Now, Ludger, of course, you're very careful in the way that you've assessed the current debt situation, looked at trajectories going forwards. Someone might say that you're being too careful. What if, the kind of scenario that Magnat and to some extent Danai described, low interest rates really allow us to be more lax than perhaps your central projection. So while I want you to address that, I also want to sneak into this conversation if the future goes badly the other way. So this is a question for Leslie, related very much to this uncertainty in the future. And that is, if you want MDBs to go double rather than AAA, who should go first? Which institution, which international institution should take that first step and risk potential stigma? And if markets then move against you because the AA, AAA, separation gets to be really large, so a future that goes the wrong way, what are you going to do with the MDB that you sit in the middle of? So let me begin with the two of you on this future going the other way, and then I'm going to bring the other respondents in on this. Ludger, may I invite you to go first?
Yeah, thanks, Danny. I think this is a very important point. And, my prediction is also that the current environment will continue for a while. But is it prudent? Is it prudent to assume that this time is different? You've heard perhaps the famous Rogoff Reinhardt saying, when they asked countries why they got into crisis, because everybody said, well, we thought this time was different. And it means that, this time interest rates will stay very low forever. Risk spreads will not react forever. And it's true, it may happen, maybe the case for a long time, and central banks, we can probably thank central banks that it has been going on for a long time. But is this a prudent approach? That I wonder, because if inflation goes up more persistently, then we think we don't want central banks to be in a situation where they have to think about the trade-offs between, monetary credibility and fiscal and financial stability, when perhaps then the markets start differentiating. The second point, if you allow me, is, well, if we think that, okay, let's use the time we have, even though, if you are at high debt levels, it takes a long time to bring down debt. If you get to 140% of GDP or 160, it takes 10, 20 years to bring that down to 100. Wherever you want to be, it takes a long time. But assume, that you want to use the good times we have in terms of financing conditions, then you also need to make sure the spending is actually productive. And my fear is that the additional money we want to spend is not going to be productive, because we are not willing to make the savings at ends where we already wasteful. And we may risk to add more wasteful spending, more white elephants to what we already spend. So yes, sorry, maybe I'm a bit on the prudent side. I think that it's good to have a lot of equity in the system. It's good for private firms. It's good for governments that we are not facing the future challenges like decarbonization and perhaps future financial crisis, geopolitical risks. Please think about that as well, without any equity in the system, without any buffers. So if I conclude with Urjit's remark about the deficit of 3.5% in 2025, it's exactly my point. The projection is that even 4 years from now, we are not going to have deficits which will bring down debt. So is that prudent? I leave it to you.
Okay, thanks. Before I'm going to turn over to Leslie to identify the banks that are going to go first. But can I press you, Ludger, a little bit on this? Because there's a way of thinking that might be, underlies what Magnat and Danai is saying, that it's not that we want the debt ratio to go exactly to zero. We just don't want it to go out of control. We just want the interest rate and the growth rate of the economy to line up the right way. And right now, it looks like with interest rates so low and growth prospects potentially strong, we might be in that, what some people refer to as a Goldilocks kind of sweet spot, where even with high levels of debt, we don't have to worry because it's not going to explode. Now, what is your prudential take on that?
I agree. And I mean, there's the Blanchard argument that as long as interest rates are lower than nominal GDP, debt doesn't explode. But Japan is a good example where debt hasn't exploded and G is larger than R. I mean, the growth rate has been 1% and inflation and interest rate 0 for the last 20 years, maybe. But debt is at 260% of GDP because the deficit has been high for 25 years and the debt ratio is going to increase further. And markets are not going to kind of kick everybody over the cliff. They're going to differentiate us at some point. They're going to say, well, a low debt country, we are happy to finance. A high debt country, we will see. And they're extremely fickle, as Urjit was saying. And we believe that it's only small and emerging economies that are going to be affected. Well, let's hope it's true, but I'm not so sure.
Okay. Thank you very much. Thank you very much for that very clear statement. Leslie.
Thanks for your question, Danny.
You want to take your institution.
I would start by saying, before I come directly to answer your question, that the central proposition I was putting forward to you today is that multilateral banks really represents a huge underutilized resource, right? Given the capital of these institutions, there is so much more that we can do within the existing limits, risk limits, and capital metrics that are there. So we have, if you like, lazy balance sheets. We can make more capital available in moments of crises like COVID. The second point to make is that when these metrics are assessed and changed, as you know, as I just highlighted to you, that the G20, which essentially own all of these banks, to put it bluntly, right? They have now put forward the idea, and already was done by the Eminent Business Group in 2018, and now under the Italian presidency of the G20, they've just put in place a commission that will review the adequacy of these metrics. If they come up and say, for example, that we can increase the leverage ratio from 3 to 5, right? The current leverage ratio, which is extremely low, that already will free up close to $1 billion in additional capital. Moving from the assumption that these are our shareholders, it's quite frankly, as far as I'm concerned, irrelevant which one becomes AA plus first, because the shareholders will simply decree. We are owned by these governments, and we have become, if you like, so focused on preserving our AAAs. If our shareholders come to us and say, you focus on development impact, how can you increase your lending? That was the central point which Magnat also made, and I agree wholeheartedly with them. We were so obsessed with the preservation of this high credit worthiness that we lost perspective of how best can we stretch our balance sheets to have bigger development impact. And given COVID, the moment is now to redesign the system. We have lived, as Magnat has said, we have reached the structural limits of the current development model. These reforms are urgent, they are necessary, and they need to be introduced now.
Thank you very much, Leslie. I want to invite the 3 respondents to possibly come in on the positions that have been taken by Leslie and Ludger. We've gotten such an interesting mix of a reform-minded approach and one that continues to preach prudence, to say that the world remains this this risky place. And from where I sit, the world could go either way. I mean, you can imagine scenarios where risk factors rise and then interest rates rise, and then we're in a whole lot of trouble trying to roll over debt that we've taken on too much. On the other hand, things might go the other way. So I wonder if I could get the three respondents to come in. Magnat first. Magnat, I need you to unmute first. Thanks. Thank you. You're on now.
No, he switched off again.
Yeah, he did switch off again. Magnat, you switched off again. I'm sorry. Yep, you're on. Don't. Yep, go ahead. Yep.
Okay. Okay. Now, you know, what I said to Ludger, that we did come down from very high debt GDP ratio in 1946 down to very reasonable level. I lived through that. I was a young man, I lived through that. And it was not painful. Coming down from high debt ratio, any country can do it if it wants. My point is that the majority of population is not benefited by fiscal orthodoxy. Crisis after crisis, the same people, women, ethnic minorities, the elderly, they are the people who suffer whenever there's a crisis. You know, in 2008, the rich did not suffer. They were given money like there was no tomorrow, as I said before. The poor suffered. So the financial crisis, in financial crisis, the rich don't suffer, the asset owners don't suffer. It's the people who have no assets who suffer. We have to correct, after 200 years of this political economy, we have to go and help the poor not to be struck down every time we have a crisis.
Okay,
and crisis we're going to have.
Thanks,
Okay.
Magnat. Yeah, reiterating a very powerful point. Thank you very much.
Yeah.
Can I turn to Denai now?
Yes, thank you. This is a really interesting question about the future, and it reminded me of this quote by John Kenneth Galbraith, the former Harvard professor, that the only function of economic forecasting is to make astrology look respectable. And of course, there's a lot of uncertainty about what future outcomes will be, but there are some things that we know for sure. So yes, this time could be different. We didn't expect the COVID pandemic and the effect that it would have on the economy, but climate change is something that we do know is coming and that we have to address. And I think I challenge what we would consider prudent in that case, because to not act can also be imprudent in terms of spending to address a crisis that we know is coming. And we have to think about the counterfactual of what would sustainability look like, debt sustainability, fiscal sustainability, not just climate and environmental sustainability, if we don't address that now, and what the cost of inaction would be. And I think the challenge that we face now is that we have to recover from a crisis, the pandemic crisis, but at the same time move to a new economic model, which is not an easy thing to do, because in the previous crisis, yes, we had to drive the recovery, but in the traditional tools and methods that we had, a consumer-led recovery, a growth-focused approach, more focused on the short term. And I think there is a risk that we may go back to that easy way to regenerate growth without thinking as much about sustainability. So I think it's important to think, what does prudent really mean in that context? Thank you.
Thank you very much. Powerful point. Thank you very much, Denai. Urjit, can I get you to say a word or two on these issues? Then I'm going to have to turn back to David, who is going to close off this OMFIF event. So Urjit, please.
Yes, I'll be brief. I had mentioned that that the kind of fiscal deficit numbers that have been projected, we need to take them with a pinch of salt, because there is this issue of conflating hopeful and optimistic scenario with baseline scenario, which a lot of institutions are doing, and we never hear about what is the pessimistic scenario. Now, you know, if you look at the deficit numbers of the rich countries going forward, the G7 or the wider group of advanced economies, those numbers, at least for two reasons, are an underestimate. One, I think redistribution pressures are very strong, and we are underestimating the kinds of expenditures that are going to be required for that. And secondly, is one form of expenditure regarding climate, which is adaptation. Now, you know, adaptation expenditures for bad climate as we saw in Europe last week, we saw in Bombay and Maharashtra in India this week, etc. Those are by nature public goods. And I think the world and therefore the governments will have to end up spending more money, firstly, I think, on climate adaptation, and possibly then hope for some climate mitigation. So I think choices will still have to be made. And I don't think we are at all in a prudent fiscal situation. So I don't think we need to worry about that. I think we have moved in that direction of being liberal, and we will continue to do so in the next few years for the reasons that I have cited, that we are underestimating these two expenditures. Last point is that helping the poor is also something that needs to be done through normal tax and spend policies of the government. It doesn't always have to be higher fiscal deficits, but if we go down this road of lower tax rates for everyone, it's not just corporations, even personal income tax payers in many countries, the top rates have declined. Then higher borrowing is the only way out. But to say that only through higher fiscal deficits you can have taking care of people at lower incomes or those who are exposed, I think is not necessarily the only way of doing it. So I'll stop there. Thank you very much.
Thank you, Urjit. Thank you all for such a wonderful, lively discussion. So many further things to follow up on. I'm afraid I'm going to have to hand over to David now. I just wanted to say very quickly, among the respondents, and Denai and Magnet most clearly, that I got the sense that, a crisis is a terrible thing to waste. We blew the 2008 one. Let's not blow the COVID one, because we can actually make some profound positive changes going forwards. At the same time that we do this, prudence and care needs to be taken. But, wonderful, rich conversation. David, can I hand over to you to close out this event?
Thank you very much, Danny. I'll just say a few brief words. We've had many really riveting and thought-provoking sessions with the National University of Singapore, the Lee Kuan Yew School, over the years. I think this has been one of the most diverse, and of course, being global and being virtual, we've been able to join together people from different parts of the world in a way we didn't before. So thank you, first of all, Danny, and your staff for helping us to put this on. It's been very diverse, but there's been some strands, I think, that we would like to follow up in the future. The idea that we should take a more systemic approach to the way that the multilateral development banks operate, as was put forward by the Eminent Persons Group in 2018, something we must follow up. Somebody will have to decide whether or not there should be AA or AAA. I don't see it's going to be easy for just one or two to go forward together. The standardization we spoke about for the ESG procedures, clearly that's like motherhood and apple pie to say we should do something about that. The ideas that you put forward, Urjit, about trying to standardize approach to net debt levels and actually codify that in a decent fashion, let's do something on that as well. Those are things we could carry forward together. Principal debate where we have, if in the British fable of Robin Hood, we have Meghdad Desai, who's the Robin Hood standing up for the poor, who always lose out in every crisis. And then we have Ludger Schuknecht, who I think is more on the side of the Sheriff of Nottingham. He's certainly been that case in the past, having been the chief economist of the Ministry of Finance at the time when Mr. Schäuble was in charge, now moving to a new job in just a few days as one of the vice presidents of the Asian Infrastructure Investment Bank. That debate has still to be fought out properly. I believe your equation, Ludger, is the right one, that financial repression will buy us time for the much needed reforms. Let's see how long financial repression goes on for. It is there now. I do believe we do have fiscal dominance. You were quite right, I think, Ludger, to talk about the fickleness of the financial markets. You said not everybody will be thrown over the cliff together. Some will go first and some will go second. And who will bail out whom, both amongst the emerging market economies and amongst the advanced countries. You were quite right, I think, to say that this problem of sustainability strikes us all. The final quote of a quote-ridden session is, of course, St. Augustine, "Lord, make us chaste, but not yet." And that, I think, is where the equation lies over your question of financial repression. So thank you, Danny. Thank you, everybody, for taking part in this. Good luck to you, Ludger, in your new job. Congratulations on this. You will win the prize, I think, for the man who has most new jobs within a short space of time at the most august international institution. So good luck to you as a member of our advisory council. You go forward to Beijing with our blessing. Thank you all very much for taking part in what has been a very stimulating occasion. And this will not be the last time that we come together, either virtually or physically. Thank you all very much. Goodbye from all of us. Goodbye.
Bye. Thank you.